Question 1. Which of the following is not a key characteristic of a fixed annuity? A. Guaranteed interest rate for the contract term. B. Flexible premium payments with no minimum. C. Fixed periodic income payments for a set period or lifetime. D. Predictable and stable returns regardless of market conditions. Answer: B. Flexible premium payments with no minimum. Explanation: fixed annuities provide guaranteed interest rates for the contract term along with fixed periodic payments to the policyholder, which can be for a specified period or for a lifetime. The key feature of fixed annuities is that the insurer guarantees a predictable and stable return, making them a low-risk option for policyholders. Option B is incorrect because fixed annuities typically require a minimum premium or a lump sum premium at the outset. Unlike flexible premium annuities, which allow for varying contributions, fixed annuities have more rigid premium payment structures. Therefore, flexible premium payments with no minimum is not a characteristic of fixed annuities. Question 2. Scenario question. Mr. Harris, a 55-year-old investor, is considering purchasing a variable annuity with a death benefit rider. He plans to use the annuity to fund his retirement and is seeking a product that will allow his investment to grow based on market performance while also providing a guarantee to his beneficiaries if he passes away before withdrawing all the funds. Based on this information, which of the following is the most appropriate advice for Mr. Harris? A. Mr. Harris should consider a fixed annuity as it provides a guaranteed interest rate and does not depend on market performance. B. Mr. Harris should avoid the variable annuity and opt for a life insurance policy with similar death benefits but without the investment risks. C. Mr. Harris should proceed with the variable annuity with a death benefit rider as it matches his goal of market-based growth and death benefit protection. D. Mr. Harris should choose a fixed immediate annuity as it will provide guaranteed payments for life, ensuring income stability for his retirement. Answer: C. Mr. Harris should proceed with the variable annuity with a death benefit rider as it matches his goal of market-based growth and death benefit protection. Explanation: Mr. Harris is looking for an annuity that allows his investment to grow based on market performance while also offering a death benefit guarantee to his beneficiaries. A variable annuity with a death benefit rider is ideal in this scenario because it provides the opportunity for market-based growth through sub-accounts, and the death benefit rider ensures that his beneficiaries will receive a guaranteed amount upon his death. Option A is incorrect because fixed annuities do not provide the market-based growth Mr. Harris desires. Option B is incorrect as a life insurance policy would not offer the same investment growth potential as a variable annuity. Option D is incorrect because a fixed immediate annuity provides guaranteed income but does not allow for market performance growth, nor does it offer a death benefit to the beneficiaries in the same way as a variable annuity with a rider. Question 3. What is the tax implication of withdrawing earnings from an annuity before the age of 591, where the earnings are taxed as ordinary income and are subject to a 10% early withdrawal penalty? B. The earnings are taxed at the capital gains rate and no penalty is applied. C. The withdrawal will be treated as a tax-free loan with no tax implications. D. Only the principal is taxed and there is no penalty for early withdrawals. Answer A. The earnings are taxed as ordinary income and are subject to a 10% early withdrawal penalty. Explanation: withdrawals from an annuity before the age of 591 were generally subject to a 10% early withdrawal penalty in addition to being taxed as ordinary income. This is in accordance with IRS tax rules for tax-deferred annuities. The principal, which was already taxed, is not subject to the penalty, but any earnings or interest accumulated in the annuity are taxed as ordinary income and also face the 10% penalty unless specific exceptions apply, such as disability or annuitization. Option B is incorrect because annuity earnings are taxed as ordinary income, not at the capital gains rate, and early withdrawals do incur a penalty. Option C is incorrect because withdrawals from an annuity are not treated as tax-free loans. Option D is incorrect because both principal and earnings are subject to tax and earnings are penalized if withdrawn before the age of 591 were. Question 4. Which of the following best describes the primary risk associated with purchasing a variable annuity? A. The return on the annuity is guaranteed, but the premiums are not. B. The annuity's value depends on the performance of underlying investments, exposing the investor to market risk. C. The annuity provides fixed interest rates, making it risk-free for the investor. D. The annuity cannot be adjusted once the contract is signed, leading to potential financial instability. Answer: B. The annuity's value depends on the performance of underlying investments, exposing the investor to market risk. Explanation: variable annuities allow the investor to allocate premiums among a variety of investment options, such as stocks, bonds, or mutual funds. The value of the annuity fluctuates based on the performance of these underlying investments, exposing the investor to market risk. Option A is incorrect because the return is not guaranteed in a variable annuity. The return is dependent on the performance of the underlying investments, which can fluctuate. Option C is incorrect because variable annuities do not provide fixed interest rates. Fixed annuities, on the other hand, offer guaranteed rates. Option D is incorrect because variable annuities can be adjusted based on market conditions, and this flexibility is one of their defining features. However, the underlying market risk remains. Question 5. What is the purpose of a guaranteed minimum withdrawal benefit rider in an annuity contract? A. It ensures the annuity holder will receive a set amount of income regardless of market performance. B. It provides a guarantee that the annuity's value will never decrease due to market volatility. C. It allows the annuity holder to withdraw a minimum amount each year, even if the account balance falls below the initial premium. D. It allows the annuity holder to take lump sum distributions without penalty. Answer: C. It allows the annuity holder to withdraw a minimum amount each year, even if the account balance falls below the initial premium. Explanation: a guaranteed minimum withdrawal benefit ride ensures that the annuity holder can withdraw a set minimum amount each year, usually a percentage of the initial premium or a guaranteed minimum, for the rest of their life, even if the account balance falls below the initial premium. This rider provides protection for the annuity holder in case the underlying investments underperform or the annuity's value decreases. Option A is incorrect because the GMWB does not guarantee a set amount of income regardless of market performance. It only guarantees withdrawals. Option B is incorrect because the GMWB does not protect against market volatility in terms of the account value, only for withdrawals. Option D is incorrect because the GMWB does not eliminate penalties for lump sum distributions, which are subject to standard withdrawal rules. Question 6. Which of the following is true regarding the taxation of annuity withdrawals? A. Withdrawals from an annuity are always taxed at the capital gains rate. B. Withdrawals from an annuity are taxed as ordinary income, with the portion representing earnings being subject to tax. C. The entire amount of an annuity withdrawal, including both principal and earnings, is tax-free after the age of 591. D. Only the principal portion of an annuity withdrawal is taxed, while the earnings are tax-free. Answer: B. Withdrawals from an annuity are taxed as ordinary income, with the portion representing earnings being subject to tax. Explanation: withdrawals from an annuity are subject to ordinary income tax. The IRS applies the last in, first out LIFO method, meaning the earnings, the last portion to enter the account, are taxed first. After reaching the age of 590 the penalty for early withdrawal is removed, but taxes on the earnings still apply. Option A is incorrect because annuity withdrawals are taxed as ordinary income, not at the capital gains rate. Option C is incorrect because only the earnings are taxable as ordinary income and the principal was already taxed when it was initially paid. Additionally, tax-free distributions would only apply under specific tax-deferred circumstances. Option D is incorrect because both the principal and earnings are subject to tax. The principal is generally not taxed again, but the earnings are. Question 7. Scenario question. Mr. Roberts, a 62-year-old retiree, is considering purchasing an annuity with a lifetime income rider. He has a moderate risk tolerance and is seeking a reliable income stream for the rest of his life, but he also wants to preserve some flexibility for emergencies. He plans to make an initial premium payment of $100,000. Based on this information, which of the following options would be most suitable for Mr. Roberts? A. A fixed immediate annuity with no additional riders, providing guaranteed monthly payments for life. B. A fixed deferred annuity where payments begin after 5 years, offering higher income flexibility. C. A variable annuity with a lifetime income rider, allowing market-based growth and a guaranteed income for life. D. A fixed annuity with a death benefit rider, ensuring guaranteed income and leaving a benefit to beneficiaries. Answer: C. A variable annuity with a lifetime income rider, allowing market-based growth and a guaranteed income for life. Explanation: Mr. Roberts is looking for a guaranteed income stream for life, but with some market-based growth potential to help keep up with inflation and provide flexibility for emergencies. A variable annuity with a lifetime income rider is appropriate because it offers both market-based growth through sub-accounts and the guaranteed income he needs for life. Option A is incorrect because a fixed immediate annuity, while offering guaranteed payments, does not allow for market-based growth, which may limit the flexibility Mr. Roberts desires. Option B is incorrect because a fixed deferred annuity delays income payments, which may not suit Mr. Roberts' need for a reliable income stream in retirement. Option D is incorrect because the death benefit rider provides a death benefit but does not align with Mr. Roberts' main goal of securing a lifetime income. Question 8. Which of the following best explains the concept of a participation rate in an indexed annuity? A. It refers to the portion of the investment gains in the stock market that the annuity holder can participate in. B. It defines the percentage of the annuity's premiums that can be allocated to underlying investment options. C. It is the rate at which the annuity's underlying investments are guaranteed to grow annually. D. It specifies the percentage of the annuity's cash value that is available for withdrawal. Answer A. It refers to the portion of the investment gains in the stock market that the annuity holder can participate in. Explanation. The participation rate in an indexed annuity determines the percentage of the index's performance that will be credited to the annuity holder's account. For example, if the index increases by 10% and the participation rate is 70%, the annuity holder would receive 7% of that increase. Option B is incorrect because the participation rate does not refer to premiums allocated to investment options. It is about the gains the annuity holder can share in. Option C is incorrect because the participation rate does not guarantee growth. It only specifies how much of the index's growth the annuity holder will benefit from. Option D is incorrect because the participation rate is not related to cash value or withdrawals, but to the investment performance and credited interest. Question 9. What is the key benefit of using a 1035 exchange to transfer one annuity to another? A. It allows for tax-free transfer of principal and earnings to a new annuity contract. B. It permits the policyholder to withdraw funds without incurring any tax penalty. C. It allows the transfer of funds without changing the contract terms or investment options. D. It guarantees higher returns on the new annuity contract. Answer A. It allows for tax-free transfer of principal and earnings to a new annuity contract. Explanation. A 1035 exchange allows for the tax-free transfer of funds, both principal and earnings, from one annuity contract to another without triggering a taxable event. This provision enables policyholders to switch annuities for better terms, investment options, or lower fees without incurring taxes. Option B is incorrect because a 1035 exchange does not allow withdrawals without penalty. It only allows the transfer of funds between annuities. Option C is incorrect because while the contract terms remain intact during the exchange, the investment options may change depending on the new annuity's structure. Option D is incorrect because the 1035 exchange does not guarantee higher returns. It only allows for the transfer of funds without tax penalties. Question 10. Which of the following is true about the surrender charge in an annuity contract? A. The surrender charge is waived if the policyholder decides to convert the annuity into a life insurance policy. B. Surrender charges apply when the annuity holder withdraws funds before the end of the surrender period. C. The surrender charge is deducted from the annuity's guaranteed income benefit. D. The surrender charge is a one-time fee applied at the time of purchase, regardless of withdrawal. Answer. B. Surrender charges apply when the annuity holder withdraws funds before the end of the surrender period. Explanation. Surrender charges are fees that apply when an annuity holder withdraws funds, usually beyond a certain amount, before the end of the surrender period. These charges typically decline over time, reducing to zero after the surrender period ends. Option A is incorrect because a surrender charge does not get waived for converting the annuity to a life insurance policy. Option C is incorrect because surrender charges are separate from the income benefit and do not affect guaranteed income payouts. Option D is incorrect because the surrender charge is applied to early withdrawals, not as a one-time fee at purchase. Question 11. Which of the following describes an immediate annuity? A. It allows the annuity holder to choose how much they want to invest and when to start receiving payments. B. It provides payments to the annuity holder that begin immediately after the initial premium is paid. C. It allows the annuity holder to defer payments until a specified date with interest accumulation. D. It allows for tax-deferred growth but does not provide any regular income payments. Answer. B. It provides payments to the annuity holder that begin immediately after the initial premium is paid. Explanation. An immediate annuity is designed to start making payments to the annuity holder immediately, or within one payment period after purchase. This is suitable for individuals seeking a steady income stream right after purchasing the annuity. Option is incorrect because immediate annuities provide payments immediately after purchase and do not allow for deferred payment options. Option C is incorrect because a deferred annuity allows for deferral of payments until a future date with interest accumulation. Option D is incorrect because immediate annuities provide income payments, unlike some other types of annuities that focus on growth rather than income. Question 12. Scenario question. Sarah is 60 years old and has $200,000 in a retirement account. She is considering an annuity that guarantees a minimum payout each year for the rest of her life, regardless of how long she lives. She's also interested in the flexibility to add extra funds later. Based on her preferences, which type of annuity would be the most suitable for Sarah? A. Fixed annuity. B. Immediate fixed annuity. C. Deferred fixed annuity. D. Fixed indexed annuity. Answer: D. Fixed indexed annuity. Explanation: a fixed indexed annuity guarantees a minimum payout each year, offers the flexibility of adding extra funds later, and can be linked to a stock market index for potential growth. This aligns well with Sarah's goal of guaranteed income and flexibility. Option A is incorrect because a fixed annuity does not provide the opportunity for market-based growth or flexibility in adding extra funds. Option B is incorrect because an immediate fixed annuity starts payments immediately, which may not suit Sarah's preference for future flexibility. Option C is incorrect because the deferred fixed annuity defers payments, which doesn't offer the same immediate payout flexibility that Sarah wants. Question 13. What does the death benefit in an annuity contract provide to the beneficiaries upon the annuitant's death? A. A lump sum payment of the original principal paid into the annuity. B. A guaranteed income stream for the beneficiary for the rest of their life. C. A return of the total premiums paid or the account's value, whichever is greater. D. A payout equal to the amount the annuitant received in income payments. Answer: C. A return of the total premiums paid or the account's value, whichever is greater. Explanation: the death benefit typically provides a return of either the total premiums paid into the annuity or the current value of the annuity, whichever is higher, to the beneficiaries if the annuitant dies. Option A is incorrect because the death benefit is generally based on the account's value or premiums paid, not just the original principal. Option B is incorrect because the death benefit does not guarantee an income stream for the beneficiary unless specifically structured. Option D is incorrect because the death benefit is usually not based on the total income payments received by the annuitant. Question 14. Which of the following is a feature of a no-lapse guarantee rider in a life insurance policy, typically used in conjunction with variable annuities? A. It guarantees the annuity will provide monthly income for a specific term, regardless of account performance. B. It guarantees that the policyholder will never need to make additional premium payments, regardless of investment performance. C. It guarantees that the annuity's value will always be greater than the premiums paid. D. It guarantees that the annuity will not lapse as long as the premium payments are made on time. Answer: D. It guarantees that the annuity will not lapse as long as the premium payments are made on time. Explanation: the no-lapse guarantee rider ensures that the policy or annuity will not lapse, meaning it will remain in force as long as premium payments are made on time, even if the account value drops due to poor market performance. Option A is incorrect because the no-lapse guarantee rider typically does not ensure monthly income but guarantees the policy's survival. Option B is incorrect because it doesn't guarantee that no additional premiums will be required, just that the policy won't lapse if payments are maintained. Option C is incorrect because a no-lapse guarantee does not ensure that the annuity's value will always exceed premiums. Question 15. Which of the following is true about a fixed annuity? A. It provides fixed, guaranteed interest rates and income for a specified period or for life. B. It allows the investor to invest in mutual funds and stocks to increase the account value. C. It has a variable rate of return based on stock market performance. D. It typically offers higher returns than a variable annuity. Answer: A. It provides fixed, guaranteed interest rates and income for a specified period or for life. Explanation: a fixed annuity provides guaranteed interest rates and guaranteed income for a specific period or for the lifetime of the annuitant. This is suitable for individuals who prioritize security and predictable income. Option B is incorrect because fixed annuities do not allow the investor to invest in stocks or mutual funds. Option C is incorrect because fixed annuities provide a fixed guaranteed return not based on market performance. Option D is incorrect because fixed annuities typically offer lower returns than variable annuities, which can benefit from market performance. Question 16, scenario question. John is interested in purchasing an annuity but wants to ensure that his beneficiaries receive some financial benefit in case of his death. He is concerned that he may not live long enough to fully benefit from the annuity's income payments. Which of the following annuity options would best meet John's needs? A single premium immediate annuity. B, a fixed annuity with a death benefit rider. C, a variable annuity with a guaranteed minimum withdrawal benefit, a deferred annuity. Answer: B, a fixed annuity with a death benefit rider. Explanation: a fixed annuity with a death benefit rider ensures that John's beneficiaries will receive a payout upon his death, which may include the total premiums paid or the account value, whichever is greater. This option provides a safety net for John's family. Option A is incorrect because a single premium immediate annuity provides immediate payouts but does not include a death benefit. Option C is incorrect because a GMWB rider provides guaranteed withdrawals but does not specifically focus on the beneficiary's needs. Option D is incorrect because a deferred annuity provides for future income but does not guarantee a death benefit. Question 17. What is the main risk associated with purchasing a variable annuity? A, the annuity holder may lose all of their initial investment if the market performs poorly. B, the annuity holder is locked into a fixed interest rate for the life of the contract. C, the annuity holder can only withdraw funds after a set period even if their financial needs change. D, the annuity holder's payments are dependent on the performance of the stock market, which may reduce income during market downturns. Answer: D. The annuity holder's payments are dependent on the performance of the stock market, which may reduce income during market downturns. Explanation: variable annuities expose the holder to market risk because the value of the annuity is linked to the performance of investments such as mutual funds or stocks. This can cause fluctuations in income, particularly during market downturns. Question 18. Which of the following is a primary characteristic of a qualified annuity? A, it is purchased with after-tax dollars and offers tax-deferred growth. B, it is purchased with pre-tax dollars and offers tax-deferred growth. C, it offers tax-free income upon withdrawal. D, it is only available to individuals over 65 years old. Answer: B, it is purchased with pre-tax dollars and offers tax-deferred growth. Explanation: a qualified annuity is funded with pre-tax dollars, meaning that the money used to purchase the annuity is not taxed until withdrawn. This allows for tax-deferred growth until the funds are distributed. Option A is incorrect because qualified annuities are funded with pre-tax dollars, not after tax. Option C is incorrect because the withdrawals are taxed as ordinary income. Option D is incorrect because there is no age limit for purchasing a qualified annuity. Question 19. Which of the following types of annuities offers both a guaranteed income stream and the ability to participate in stock market growth, subject to cap? A, fixed annuity. B, immediate annuity. C, fixed indexed annuity. D, variable annuity. Answer: C, fixed indexed annuity. Explanation: fixed indexed annuity offers a guaranteed income stream and allows the annuity holder to participate in market growth through an equity index, though returns are typically capped. Option A is incorrect because a fixed annuity offers a guaranteed income stream but no participation in market growth. Option B is incorrect because an immediate annuity starts payments immediately and does not involve market participation. Option D is incorrect because a variable annuity involves direct market investments and does not have the guaranteed interest associated with fixed indexed annuities. Question 20. What happens when a policyholder takes a partial surrender from their life insurance policy with an attached cash value? A, the policyholder must pay taxes on the amount withdrawn and the death benefit decreases. B, the entire cash value is available to be withdrawn without any tax liability. C, the insurance company provides the policyholder with a loan that must be repaid with interest. D, the policyholder's premiums are reduced as a result of the partial surrender. Answer: A, the policyholder must pay taxes on the amount withdrawn and the death benefit decreases. Explanation: when a policyholder takes a partial surrender, the amount withdrawn is usually subject to taxes to the extent that it exceeds the cost basis of the policy. Additionally, the death benefit is typically reduced by the amount of the withdrawal. Option B is incorrect because the withdrawal is usually taxable if it exceeds the amount paid in premiums. Option C is incorrect because a partial surrender is a withdrawal of funds, not a loan. Option D is incorrect because the policyholder's premiums are not typically reduced by a partial surrender. Question 21. Which of the following is a typical feature of a riders in life insurance policies? A. They reduce the premiums the policyholder pays by adding coverage options. B. They are free add-ons that automatically increase the death benefit. C. They can provide additional coverage or benefits such as waiver of premium or accidental death. D. They guarantee that the life insurance policy cannot be cancelled by the insurer. Answer: C. They can provide additional coverage or benefits such as waiver of premium or accidental death. Explanation: riders are additional provisions that can be added to a life insurance policy to enhance its coverage. They often provide extra benefits like waiver of premium if the policyholder becomes disabled or coverage for accidental death. Option A is incorrect because riders typically increase premiums rather than reduce them. Option B is incorrect because riders are usually not free and do not automatically increase the death benefit. Option D is incorrect because riders do not guarantee that a policy cannot be cancelled, and this depends on the policy terms. Question 22. Scenario question. Lina is planning to retire in 5 years and is considering purchasing a deferred fixed annuity. She is interested in tax-deferred growth and guaranteed income later in life. Which of the following statements best describes how a deferred fixed annuity works? A. Lina would receive immediate income payments, but the amount is fixed and guaranteed. B. Lina can invest her premiums in the stock market and receive variable income. C. Linda's premiums would grow tax-deferred, and she can begin receiving guaranteed income in the future. D. Lina must begin taking withdrawals immediately after purchasing the annuity. Answer: C. Linda's premiums would grow tax-deferred, and she can begin receiving guaranteed income in the future. Explanation: a deferred fixed annuity allows Linda's premiums to grow on a tax-deferred basis until she decides to start receiving income, which will be fixed and guaranteed once she begins withdrawals. Option A is incorrect because a deferred annuity does not provide immediate income. Option B is incorrect because a deferred fixed annuity does not involve market-based investments. Option D is incorrect because deferred annuities allow for the deferral of withdrawals until a specified future date. Question 23. Which of the following is true about an annuity's liquidity? A. An annuity's liquidity is always high, allowing the holder to access funds at any time without penalty. B. An annuity's liquidity is limited due to surrender charges and restrictions on withdrawals. C. An annuity's liquidity depends solely on the insurance company's financial situation. D. Annuities provide unlimited liquidity without any charges or restrictions. Answer: B. An annuity's liquidity is limited due to surrender charges and restrictions on withdrawals. Explanation: annuities typically have limited liquidity, especially during the early years of the contract when surrender charges and withdrawal restrictions apply. Option A is incorrect because annuities generally have limitations on withdrawals during the surrender period. Option C is incorrect because liquidity is based on the annuity contract, not the insurance company's financial status. Option D is incorrect because annuities do not provide unlimited liquidity. There are often penalties or restrictions for early withdrawals. Question 24. What is the main advantage of an annuity with a guaranteed minimum withdrawal benefit? It guarantees the annuity holder minimum income regardless of market performance for the duration of their life. B. It provides a guaranteed income for a set period with payments based on stock market performance. C. It ensures the annuity holder receives at least the amount they initially invested even if their investment loses value. D. It guarantees that the annuity holder's premiums will be refunded to their beneficiaries if they die prematurely. Answer: C. It ensures the annuity holder receives at least the amount they initially invested even if their investment loses value. Explanation: the GMWB guarantees the annuity holder a minimum income even if their account value declines due to market performance. That ensures that they can withdraw at least the amount they invested regardless of the market performance. Option A is incorrect because GMWB guarantees income but not necessarily for life depending on the contract. Option B is incorrect because GMWB involves withdrawals, but not based on market performance. Option D is incorrect because the GMWB guarantees withdrawals, not a refund of premiums upon death. Question 25. Which of the following annuity types provides the highest potential for investment growth? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Deferred annuity. Answer: C. Variable annuity. Explanation: variable annuities offer the highest potential for investment growth because they allow the annuity holder to invest in a variety of sub-accounts such as stocks, bonds, and mutual funds, which can increase in value depending on market performance. Option A is incorrect because fixed annuities provide a guaranteed but lower return. Option B is incorrect because immediate annuities provide guaranteed income but do not offer investment growth. Option D is incorrect because deferred annuities offer tax-deferred growth but do not involve high-risk investments like variable annuities. Question 26. Which of the following is an example of a living benefit rider in a life insurance policy? A. The policyholder receives a guaranteed death benefit. B. The policyholder can access part of the death benefit if diagnosed with a terminal illness. C. The policyholder can choose the beneficiary for the death benefit. D. The policyholder is able to convert the policy to a permanent insurance policy. Answer: B. The policyholder can access part of the death benefit if diagnosed with a terminal illness. Explanation: a living benefit rider allows the policyholder to access part of the death benefit if they are diagnosed with a terminal illness, providing financial support during their lifetime. Option A is incorrect because the death benefit is typically the benefit paid after the policyholder's death, not a living benefit. Option C is incorrect because the policyholder can generally choose the beneficiary of the death benefit without a living benefit rider. Option D is incorrect because converting the policy typically involves a different type of rider, such as a conversion rider. Question 27. Which of the following types of annuities is most likely to provide a higher income to the annuitant? A. A single premium immediate annuity. B. A fixed deferred annuity. C. A variable annuity. D. A fixed indexed annuity. Answer A. A single premium immediate annuity. Explanation: a single premium immediate annuity provides a guaranteed income stream starting immediately after the premium is paid. This type of annuity typically offers higher income payments because it begins paying out right away, with the annuitant's premiums not needing to accumulate for years before payouts begin. Option B is incorrect because a fixed deferred annuity delays payouts, allowing funds to grow, but this generally results in lower income payments when withdrawals begin. Option C is incorrect because a variable annuity's income is dependent on market performance, and while it can potentially provide higher returns, it also carries more risk. Option D is incorrect because a fixed indexed annuity offers growth potential based on stock market indices, but generally does not provide as high an income payout as a single premium immediate annuity. Question 28. Which of the following is true regarding the surrender period in an annuity contract? A. The surrender period allows the annuity holder to withdraw funds without penalties at any time. B. During the surrender period, early withdrawals are subject to surrender charges, but the policyholder can access their funds at any time. C. After the surrender period ends, withdrawals are allowed without any penalties or charges. D. The surrender period only applies to fixed indexed annuities. Answer: C. After the surrender period ends, withdrawals are allowed without any penalties or charges. Explanation: the surrender period is a set period during which the annuity holder may be subject to surrender charges if they withdraw funds early. Once this period ends, the policyholder can access their funds without penalties or charges. Option A is incorrect because the surrender period does not allow penalty-free withdrawals. Option B is incorrect because early withdrawals during the surrender period are penalized with surrender charges. Option D is incorrect because the surrender period applies to most types of annuities, not just fixed indexed annuities. Question 29. Which of the following annuity features would most likely appeal to an individual looking for a guaranteed minimum income, but also the ability to benefit from market growth? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Fixed indexed annuity. Answer: D. Fixed indexed annuity. Explanation: a fixed indexed annuity provides a guaranteed minimum income, often through a fixed interest rate, while allowing the annuitant to benefit from market growth, though typically with a cap on the returns. Option A is incorrect because a fixed annuity offers only a guaranteed return with no potential for market growth. Option B is incorrect because an immediate annuity provides income right away but doesn't offer market growth potential. Option C is incorrect because a variable annuity offers potential market growth but does not guarantee a minimum income. Question 30. Which of the following statements about annuity death benefits is true? That annuities with death benefits pay out the accumulated value of the annuity to the beneficiary. B. Death benefits on annuities are tax-free to beneficiaries, regardless of the annuity's value. C. The death benefit is generally paid out only if the annuitant dies before receiving any income. D. A death benefit is only available in certain types of annuities, like variable annuities. Answer A. Annuities with death benefits pay out the accumulated value of the annuity to the beneficiary. Explanation. An annuity with a death benefit typically pays out either the accumulated value of the annuity or the guaranteed minimum amount to the beneficiary upon the annuitant's death, depending on the contract. Option B is incorrect because death benefits may be subject to taxes depending on the annuity type and the tax laws at the time of death. Option C is incorrect because a death benefit can be paid even if the annuitant is receiving income depending on the contract. Option D is incorrect because death benefits can be available in both fixed and variable annuities, not just in variable annuities.